When we look at a stock exchange during a downturn, the reaction is immediate fear. We see a chaotic blur of red numbers ticking downward. An investing dashboard operates by a specific set of rules. It is an instrument panel designed for navigation, where each dial tells you exactly where your capital stands and how it is performing. By learning to read this panel, we stop trying to make lucky short-term bets. We step into the role of long-term owners, which turns moments of severe market distress into clear opportunities to buy assets at a steep discount. To test this approach, we first need a standard brokerage account. For this diagnostic, we are going to use the COL Financial platform as our testing environment. This is the COL Financial Account Summary page. It is our primary diagnostic tool for evaluating financial health, giving us a complete breakdown of cash, equities, and mutual funds. First, we look at the cash balance. Think of this as your baseline fuel. This is the money parked securely in the account ready to be deployed. Next, we have equities. When you buy equities, you are purchasing a direct physical piece of a real business. Notice the stock codes here, like AC, BDO, and JFC. Finally, we see mutual funds. This is a system where you hire a professional to buy and manage a diverse basket of companies on your behalf, like the XCO Life Index Fund. Breaking the screen down into these three buckets removes the noise. It organizes the data into a clear inventory of what you own and how much cash you have ready to deploy. This is the Philippines Stock Exchange Index chart on the COL Market Information page, displaying historical and intraday movements. The downward slope clearly shows that the broader Philippine market is currently going through a severe downturn. Watching an index drop understandably causes panic, but that panic stems from misunderstanding what market value actually means. On our portfolio summary, negative red numbers appear under market value, the cash you'd receive if forced to sell today. But look at uncommitted shares. Even if market prices drop, this count stays exactly the same. Your ownership doesn't shrink when values fluctuate. Those red numbers only lock in as permanent losses if you panic and sell your uncommitted shares. Until you hit the sell button, they are just temporary price tags on assets you still safely own. Holding on to those uncommitted shares during a market downturn that lasts for years requires extreme patience. It's difficult to wait when the screen stays red. The financial reward for that patience comes in the form of dividends. A dividend is a portion of a company's actual profit paid out in cash directly to you simply because you hold the shares. In the Philippines, dividends carry a distinct tax advantage. They are taxed at a rate of 10%, compared to the 20% tax on interest income from bonds. This makes dividend-paying companies a highly effective alternative for generating fixed income. By collecting regular payouts, a stagnant red portfolio turns into an active machine generating passive income. You get paid in cash while the market recovers. This brings us to the ultimate stress test question. How do we safely deploy our capital and buy into a weak market without trying to guess when prices will hit rock bottom? We use a strategy called cost averaging, often applied through tools like the Easy Investment Program. The rule is simple. Commit to investing a strict fixed amount of money every single month. During a crash, cost averaging works to your advantage. Lower prices mean your fixed cash buys more shares. When the market recovers and stocks become expensive, that same cash naturally buys fewer shares, protecting you from overspending at the peak. By committing to a fixed schedule, cost averaging mathematically removes human emotion from the process. It forces you to acquire more assets when prices are low, entirely removing the need to predict the future. Looking at this table of the 20 most active stocks on the exchange, we can see that the market will always feature massive daily trading volumes and moments of extreme panic. But behind all of that daily noise, the rules of our diagnostic test hold true. Gather uncommitted shares in real companies, collect your cash dividends, and automate your buying. Sticking to this discipline allows you to survive the short-term turbulence. It clears the path toward achieving long-term financial stability. Understanding this instrument panel gives you control over your own financial data. It allows you to ignore the daily noise and use these specific tools to build your share counts year after year. Prices for everyday goods are climbing, global tensions are dominating the news, and the local market is struggling. Putting your money into investments right now can feel dangerous. The closure of the Strait of Hormuz in early 2026 cut off the primary artery for global oil. For the Philippines, a nation entirely dependent on imported crude, the macro consequences hit immediately. The peso dropped to 61.75 against the dollar, and inflation spiked to a 3-year high of 7.2%. That external energy shock acted as a sledgehammer to domestic equities. The Philippine Stock Exchange Index, or PSEi, was dragged below critical support levels as institutional investors rushed for the exits. In a live market crash, panic is the default reaction. We're going to use an online brokerage platform to diagnose your personal exposure and execute a deliberate defensive strategy. Logging into COL Financial, we check the top ticker. The PSEi sits at 5,896.80, down nearly a full percent. Mastering this digital interface separates strategic survivors from victims of global inflation. You must know exactly where to look. Step 1 is confronting the immediate damage. Navigating to the portfolio tab gives a real-time summary of our equity holdings. Historically safe blue chips are bleeding. Ayala Corporation is down 21% and Jollibee Foods has cratered by 37%. These steep drops do not indicate that these businesses are failing. Instead, the market is aggressively pricing in an energy-induced discount. High fuel and operating costs compress profit margins, and investors are repricing that reality. Recognizing the difference between a broken company and an engineered liquidity drain keeps you from panic selling at the absolute bottom. Step 2. Track market breadth. In the most active data, heavy sell-off volumes hit highly liquid assets like ICT, Ayala Land, and Meralco as foreign funds liquidate. But notice the anomaly. BDO holds flat at 0% change. Building reserves provides a pocket of stability. To understand this rotation, we consult the latest research section. The consensus points to navigating weak earnings, higher yields, and relentless peso pressure. This introduces the yield protection strategy. REITs like CREIT, AREIT, and FILRT have posted stable Q1 earnings, offering a defensive shelter. Smart money does not exit the market during stagflation. It simply rotates out of capital appreciation targets and into dividend-yielding vehicles. To execute this rotation, you take your uncommitted cash balance and set up a mechanical buy order to acquire shares in these REITs. This chart shows the logic behind the move. The steep 30-day decline represents a generic growth stock index, while the flat stable line tracks a dividend-adjusted REIT index. Those high-yield dividends act as a direct hedge to preserve your purchasing power against the 7.2% inflation rate. Let's test this. Based on the macro data we just analyzed, mentally select 2 sectors you would buy right now and 1 sector you would avoid. To summarize, your crisis dashboard checklist has 4 steps. 1. Check the macro ticker. 2. Assess the portfolio bleed. 3. Read market breadth. And 4. Rotate to yield. Surviving a geopolitical energy shock does not require predicting the future of a war. It requires strict adherence to a mechanical, data-driven workflow on your trading dashboard.